Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Lion Electric stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a microcap company, 226 million market cap. They're trading at $1 a share, and they have 226 million shares outstanding. Lion Electric designs, develops, manufactures, and distributes medium and heavy-duty urban vehicles in North America. Their products include battery systems, chassis, bus bodies, and truck cabins. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Every year they have negative free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. They did have a surprise positive in 2022, but negative all the other years. The reason they had positive net income was not because their revenue was higher than their expenses. It's because they passed through a big game in other income and expenses. Revenue is a sales for the company, and that does go up from 58 million to 250 million. But 250 million is not enough for this company to be profitable. They need to be north of 2-3 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows, past year 4. That's negative 282 million. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of negative $400 million. We divide that by 226 million shares. And we get a calculated stock price of 0. They're trading at $1, so it's a big sell according to the model. I use many different models to value the stock, and there's not one scenario where the company's profitable. Every scenario is the company goes bankrupt. There are 27 companies in the same industry as LEV, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 100 million in capex, more than the median. They have a debt to equity ratio of 1. For every dollar of equity, they have $1 of debt, which is really, really bad when you have negative free cash flow. If they had positive free cash flow like some of these companies, then it's not bad. But any debt, when you're not bringing in money, is terrible, because the only way to pay off the debt is to take on more debt. They rank 19th in market cap of the 27 companies. They cracked the top 20. Price to book is below 1, which implies they're worth more in bankruptcy than as an operating entity. We can't look at that PE or price to free cash flow. Negative earnings, negative free cash flow. Price to sales is below 1, so investors are paying 90 cents for $1 revenue. When a company has a price to sales below 1, that means their revenue is higher than their market cap. And if you put $10,000 into this company when they started trading, you'd be really unhappy at $1,000 today, a 90% loss. But right after they started trading, your $10,000 would have been close to $30,000, because there's always a lot of hype about new companies, especially new companies in the EV industry. But when investors realized the company's crap and sold off their stake, the stock went down a lot. Let's look at their full income statement. Revenue of 55 million, cost of revenue 66 million. So they lose money on every sale, but they make it up in volume. A gross loss of 11 million. It's impossible to have a long-term successful business if you have a gross loss. You could have an operating loss and do okay in the long term, assuming it becomes positive at some point, but a gross loss, it's impossible. Their revenue did go up from the first quarter of 2023, but look how much their revenue went down in Canada. It was 52 million, now it's 43 million. But they made it up in the US from 2 million to 12 million. That's not good when your own country doesn't believe in your product. Below gross loss are their operating expenses. Admin expenses 11.1 million, selling expenses 3.8 million. Most of these expenses are payroll. They spend 11 million of interest on their debt, and they did pass through a gain of 10.7 million when they revalued their convertible debt. So they sold convertible debt, which means the owner of the debt receives interest payments, and they could convert the debt to equity if they want to. The only way the holder of the debt will convert it to equity is if the stock price goes above the strike price. The strike price is $2.58. The company wants them to convert the debt to equity, because if they do not, then Lion Electric has to pay the holder of the debt the principal they put into the company. They mention it right here. The holders of the convertible debentures will either 1 or 2. 1 is convert all their debentures to common shares, or the company has to repurchase for cash all their debentures at a purchase price of 150% of the principal, as well as accrued, compounded, and unpaid interest, which the company does not want to do because they don't have enough cash to buy back that debt, which is pretty likely to happen because the stock price is not going up anytime soon. So the company has to take on more debt to pay the old debt, like a Ponzi scheme. They also pass through a gain of $6.7 million in the change of fair value of warrants. Warrants are long-dated options. Debentures are unsecured debt issued by the company. So this is why they passed through a gain in 2022, the revaluation of these securities. So they have a net loss of $22 million. It would have been a lot higher if it wasn't for the gain in these two securities. It should have been a net loss of $26 million plus 10.6 plus 2.5. So this is roughly $13 million. So it should have been a loss of $39 million. Instead, it was a loss of $22 million. So to see the shares outstanding, we can look at the consolidated statement of changes in equity. After the income statement, balance sheet, and statement of cash flows, this is the next most common statement. And the fifth financial statement is accumulated other comprehensive income. That shows the unrealized gains or losses that aren't part of the regular income statement. In January 2023, they had 218 million shares outstanding. In March 2023, 223 million. They added 5.5 million. In January 2024, 226 million. They only added 33,000 by 3/31/2024, 226.2 million. Let's take a look at the statement of cash flows. The statement of cash flows converts their net loss into cash. It subtracts the 6.7 million from the warrants, the 10.7 million from the convertible debt instruments, because those are non-cash items. There's also a cash outflow of 21 million from changes in working capital. These are changes in accounts payable, accounts receivables, inventory. So they had a cash outflow of 44 million in the first quarter. Last year, it was a cash outflow of 38 million. In their investing section, they spent 3.8 million of PP&E, last year 28 million. They did receive 3.1 million of government assistance. That was related to the purchase of PP&E. Here is some mention of government assistance. In April 2023, the company received an advance of government assistance of $7 million, 9.5 million Canadian dollars, from the Investment Bank of Quebec relating to future vehicle development project costs, of which the full amount has been incurred and recorded as a reduction of intangible assets. In their financing section, they took on 37 million of debt. They paid 4.4 million of debt. They paid 2 million of lease liabilities. So it's just a ticking time bomb until the company blows up. Cash at the beginning of the accounting period, 30 million. Cash at the end, 4.8 million. So they had a cash outflow of 25 million in the first quarter. The way you calculate 25 million, it's just negative 44 million from operating cash, negative 12 million from investing cash, and positive 30 million from financing cash. So the sum of those three is negative 25 million. So they started with 29.9 million of cash, and they ended with 4.8 million. And this 4.8 million you'll see on the balance sheet. I'll show you right now. Here's the 4.8 million cash at the end of the accounting period. And here's the 29.9 million cash at the beginning of the accounting period. The beginning of the current quarter is the end of the prior quarter. Let's look at a company on Simply Wall Street. Its last price, $1, 226 million market cap, down 5% in the past week, down almost 50% in the past year. The company started trading in mid-2021. It looks like about $17 IPO. If you could have bought at that price and sold a month later, you could have made money. After that, it's all been downhill. There's been some upticks here and there. October 2021, it was 11, then it went to 15 the following month. But if you held the stock for more than 3 months, you lost money. The only way you can make money is either shorting it or a really short-term trade. In the past year, it's been between $1 and $2. If it stays below 1 for an extended period of time, they may get delisted. Simply Wall Street does not value this stock. 2 analysts priced this stock at $250. The revenue forecast for this year is 300 million, next year 500 million, after that 750 million. The free cash flow forecast is negative for the foreseeable future. They were pretty much debt-free in 2018, then they added a bunch of debt in 2021, but paid it down, so they had very little debt in 2022, but they started adding some each year to fund their expenses. Now they're up to $257 million of debt. The blue line is their equity, which is higher than their debt currently, $330 million of equity. And the green line is their cash. So when they do a capital raise, they get a bunch of cash. This big amount right here is probably from the IPO, and then they burn through that cash. It's almost down to zero. The only thing that's going up is a CEO's salary from $215,000 to $485,000. Total compensation, $1.6 million. Tenure as CEO, 16 years. In the past year, there's been one insider sell by the CEO, 500,000 shares at $222. 44% of the company is owned by the general public, the same amount by institutions, and 12% by insiders. Their biggest shareholder is Power Energy. They own 34%. That's a Canadian company that invests in renewable energy companies. The CEO is the second biggest shareholder at 11.5%. XPND is a Quebec-based private equity firm. Like Power Energy, they invest in sustainable companies. The next biggest shareholder is Invesco, 1.8%. A bunch of Canadian banks, Bank of Montreal, TD, RBC, and CIBC. Well, their employee count has gone up from 500 employees to 1,400. It was 1,500. It looks like they laid off some. And the ticker trades on the TSX, New York Stock Exchange, and Deutsche Börse. Let's learn about the history of the company. They started out as Autobus Lion in 2011. And that company was the first manufacturer of full-size school buses in Canada. In 2011, the company introduced its first bus, the Lion 360-degree school bus, produced in partnership with Spartan Chassis. In 2017, Lion Bus rebranded itself as the Lion Electric Company. As part of the transition, the company announced the development of a second bus design, a flat-floor, fully electric minibus for school and transit applications. In addition, Lion announced the development of Class 5 through Class 8 fully electric trucks with a planned launch in fall 2018. Trucks have classes from 1 through 9, and it's based on the weight of the truck. Classes 1 through 3 are non-commercial vehicles. Class 4 has a range between 14,000 and 16,000 pounds. This is the class you may find the Ford E450 passenger van and the F450 Super Duty pickup truck. Box trucks typically fall into this truck classification. So do some large walk-in and city delivery trucks. Class 5 are between 16,000 and 19,500 pounds. There are still a few vehicles in this class that straddle the line between non-commercial and commercial, such as Ford's F550. However, this class is where more commercial vehicles emerge. It includes larger walk-ins and delivery trucks, as well as bucket trucks and cherry pickers. Class 6 is between 19,500 and 26,000 pounds. This class covers medium-duty commercial trucks. It's the category for single-axle and beverage trucks, along with rack trucks. School buses are also in Class 6. This class is where the need for commercial driver's licenses starts. That requirement depends on the individual vehicle weight. Driving vehicles weighing more than 26,000 pounds require a CDL. Heavy-duty classification covers classes 7 and 8. That's where you will find the big rigs and other commercial vehicles. The weight for Class 7 is 26,000 to 33,000 pounds, and they usually have 3 axles or more. An axle is a rod or shaft that connects a pair of wheels to propel them and retain the position of the wheels to one another. The Class 7 covers city vehicles such as street sweepers, garbage trucks, and city transit buses. Furniture trucks and smaller semis fit into this category as well. Class 8 is for the really huge trucks, over 33,000 pounds. The vehicles in this class are heavy duty. Class 8 is for cement trucks and dump trucks. It's also where you'll find the big rigs like Freightliners, Kenworths, and Peterbilts. In November 2017, Power Energy announced a major investment in Lion Electric. We saw that earlier on Simply Wall Street, that Power Electric is their biggest shareholder. And then in the summer of 2018, Lion Electric started manufacturing in Central California. In 2021, Lion announced a new manufacturing facility in Joliet, Illinois, to produce its electric buses and trucks. And then it became a public company by merging with a SPAC, a special purpose acquisition company. In May 2021, Lion received an order from First Student for 260 electric buses, its largest order at that point. First Student is a North American provider of school bus services. The company works with 38 states and 7 Canadian provinces, and they carry 5 million students daily. That's the history of the company. Let's go through some of their products. They launched the Lion 360 in 2011. That's a cow-led chassis bus sold as either a school bus or a commercial use bus. Similar to the Bluebird Vision, the 360 does not use a chassis and a hood of a production medium-duty truck. Instead, it has a proprietary chassis developed for the bus by Spartan Chassis. That bus does offer wheelchair option or underfloor luggage compartments. Several features of the 360 focused on lengthening the service life of school buses. In the interest of corrosion resistance, the body does not use steel exterior panels, consisting of composite body panels. The 360 is produced with a 102-inch wide body, rather than 96 inches. The change was intended for either wider center aisles or to better accommodate 3-point seatbelts. In May 2015, Lion unveiled a CNG-fueled variant of the 360, becoming the first manufacturer to produce a Type C school bus powered by a CNG-fueled engine. CNG is compressed natural gas. It's a gasoline and diesel fuel alternative consisting of methane. The company launched the E-Line in 2015, a fully electric vehicle, sharing its body and Spartan chassis with the 360. They run that vehicle on LG lithium-ion batteries. Because it's an electric car, it does not make engine sounds, so when they travel below 15 miles per hour, they play a sound similar to the door closing sound of the Montreal Metro. Because you don't want to run over little kids, right? In 2018, they launched the Lion M, a low-floor minibus produced in a 26-foot length, offering kneeling and an integrated wheelchair ramp. The Lion M was developed for transit, paratransit, and shuttle applications. The Lion A is a Type A school bus, adopting the axle configuration of a much larger Type D bus. And they also made a larger school bus called the Lion D. The Lion M and A are equipped with either 1 or 2 lithium-ion battery packs mounted below the floor, which allows for a 75-mile or 150-mile driving range. There is a fast charging option along with battery swapping. The Lion 8 was introduced in March 2019. The Lion 8 is a Class 8 fully electric truck produced in a cab-over configuration, developed primarily for urban and vocational use. The Lion 8 has a range of 250 miles. It's equipped with a 470 horsepower electric motor and a 480 kilowatt per hour battery. So that's the end of the video. Let me know what you think. Thanks for watching.